Hey class, so I wanted to take a little bit of time to look at some of the transactions here you're going to encounter in chapter 4. We're going to be dealing with inventory transactions in this chapter, and one of the big challenges you're going to see when you go through these entries is a lot of debits and credits. So hopefully you've invested that time in chapter 3 to really get these debits and credits down. It's going to take practice, a lot of repetition in this chapter, and one of the challenges you're going to see is that the problems go through and they're going to switch you back and forth between being the buyer of inventory and being the seller of inventory. And you've got to really pay close attention to that because that's going to dictate the types of entries that you're going to make. So I want to go through just a couple of these entries here, and then I think you should be able to take and apply these to pretty much any problem, as they're pretty much the same once you kind of get the pattern down. So I want to look at this first exercise here. Hopefully you can see this. Let's take a look at number 1 here for Walker Company. It says Walker Company purchased $2,500 of merchandise on account. The terms were net 45, FOB shipping point, which means the buyer pays, and Walker separately paid cash to the freight company $30. Okay, so we're going to take a look at each one of these pieces of information here and see if we can then put them into their proper accounts, debits and credits. Let's start with Walker purchased $2,500 of merchandise on account. Terms N45. The N45, of course, means net 45. Now, there could have been terms on this, like a percentage discount. We'll get to that in a minute, but not on this one. This just simply means that Walker is purchasing this inventory, and it's on account, and they have to pay it within 45 days, but they're not eligible for any sort of a discount. So we don't really need to worry about that N45 per se just yet. We just need to record this purchase transaction for $2,500. So what I'm going to do here is I'm going to start by debiting inventory, because what did you do? Well, you bought inventory, right? So it's a good place to start. So I'm going to debit inventory $2,500, and I'm going to credit accounts payable. Why? Because it was on account. That's what the problem told us. Don't read anything into it. If it said it would purchase for cash, then that's what it would have been. But this one actually said it was on account. So my entry is going to look like this. I'm going to have a debit inventory and a credit to accounts payable. Now, it said it was FOB shipping point, and the buyer pays in FOB shipping points. You got to remember that as well. We're the buyer here, right? Walker Company is the buyer. So we're acting in the role of the buyer here. And since we paid $30 to have this inventory shipped to us, we're going to credit cash, $30, and we're going to debit inventory, $30. Now, you might be wondering why. Why do we debit inventory for $30 here? Well, the reason is because we always want to record inventory at its cost. And because we had to pay an additional $30 to have this inventory shipped to us, we're going to add it to the inventory balance by debiting the inventory balance. So when you're the buyer, that's what you do when you have to actually pay to actually have that cost, or have the cost of the shipping to have it shipped to you. All right? All right, let's take a look at number 2. Number 2 says, recognize revenue of $800 on the cash sale of merchandise. The cost of the merchandise sold was $620, and the merchandise shipped was FOB destination. And that means the seller pays, right? And then it says Walker paid $20 in shipping costs. Now, this time, we're the buyer or the seller, right? It says we recognize revenue on the cash sale of merchandise. So we're now the seller here. So these entries are going to be different. So let's start with this $800 of revenue that we earned on this sale. We're going to start by, since this was a cash sale, we can go ahead and start by increasing cash by $800, right? So we're going to do that, $800. And we're going to also increase sales revenue by $800. Right? That's going to be the very first part of that entry. All right. So we're going to debit cash and we're going to increase sales revenue. But we're not done yet. Anytime you do a sale entry, you got both the sale part, which was the $800, but you also have to record the cost of the merchandise sold. The cost of the merchandise sold was $620 in this case. So here's what we're going to do with that. We're going to debit $620 to the cost of goods sold account, which is essentially an expense account. And we're going to credit inventory for $620, which is the cost of the inventory leaving our books. So again, you're going to have a debit to cost of goods sold and a credit to inventory for the cost of that merchandise. Okay? Now, we also have to deal with the $20 in shipping costs. Remember, the seller in this case, since it was FOB destination, the seller actually paid for it. And guess what? We're the seller here. All right, but this is a different entry here. Part of it's different, at least. We're going to start out by crediting cash. Why? Because we had cash go out the door, and we're going to decrease cash. So we're going to decrease cash by $20. And this time, we're going to debit an account called transportation out expense. It's actually an expense account. It's actually an expense account. And the reason why we're going to do that is because this essentially is a selling expense. So this is different. So, when we were the buyer, we increased the cost of the inventory because it was increasing the cost of the inventory. But when we're the seller and we have to pay for shipping costs, it's just a selling expense to us. And so we put it to this strange account name called transportation out expense. Okay? All right, great. Let's take a look at number 3. Number 3 says, Walker paid for the merchandise in number 1. All right, this is an easy one. Well, where was that amount from number 1? Well, if you remember, that amount from number 1 is sitting in our accounts payable account, isn't it? And that's what they're referring to. So now, if you also remember from number 1, there were no discounts to apply here, so we don't have to worry about that. We just need to simply pay the $2,500. So we're going to credit cash $2,500, and we're going to debit accounts payable $2,500. That's going to clear out the accounts payable account. So again, a credit to cash and a debit to accounts payable, and that takes care of number 3. All right, let's take a look at number 4. Number 4 says, Walker purchased $3,000 of merchandise from its supplier on account. Terms are $315 and $45, and there are no shipping costs. Okay, now we're back to being the buyer, aren't we? Back to being the buyer. And there were terms that whoever we bought this from offered us, $315 and $45. So that simply means what? It means that if we pay this bill within 15 days of the invoice date, we can take a discount of 3%. If not, the full amount is due in 45 days. All right, well, do we have to worry about those terms just yet? No, not yet, because we're not sure whether or not we're going to take it. There's a good chance we'll take that discount. It's a pretty good discount, but we're not positive. So all we're going to do is worry about the $3,000 right now. And since we purchased the merchandise, we can go ahead and increase inventory, $3,000. It's not a bad place to start. So we're going to debit inventory, $3,000. This is number 4. And since it said it was on account, we're going to increase accounts payable by that same $3,000. So again, if you look at this entry here, you're going to have an increase to accounts payable, $3,000, and an increase to inventory, $3,000. And that's all we need to worry about that. Now, we'll keep an eye on that discount because it's going to come down probably later on when we actually take those discounts take that discount when it comes time to actually pay for it. All right, let's take a look at number 5. Number 5 says we recognized revenue of $4,000 on the sale of merchandise on account. Terms of the sale were $210 net 30. Cost of merchandise sold was $2,400, and there were no shipping costs. All right, we're back to being the seller now. Again, so just always know what side you're on. We're back to being the seller. All right, let's just work through this in order. $4,000 on the sale of merchandise on the account. The terms are $210 net 30. All right, we know how to read that. 2 meaning 2% discount if the buyer pays for it within 10 days. This is what we're offering the buyer now, right? If they don't take advantage of that discount, then the net amount is due within 30 days. So it's really up to them. So since we don't know whether they're going to take advantage of that discount just yet, we're going to record the $4,000. And then we'll deal with that discount later on if they choose to take advantage of it. Okay? So let's start by recording the revenue of $4,000. And it said it was on account. So since it was on account, we're on the buyer or the seller side here. We record that where? We record that in accounts receivable. Remember, accounts receivable is an asset, increases on the debit left side. So we're going to increase $4,000 to the debit left side of accounts receivable. All right. And then the credit's going to go where? It's going to go to sales revenue. If you think about it, it should make sense, right? That was actually the sale amount to the customer. All right, we're not done yet though, because it also said the cost of the merchandise sold was $2,400. So when you record that, just like we did the last time, we're going to have a debit to cost of goods sold of $2,400, and we're going to have a credit to inventory of $2,400. All right, so just think about that. That was 2 pieces to this same transaction, was it not? We have the $4,000 increase to sales revenue and to accounts receivable. And then we have the cost of the merchandise sold, which was $2,400. That was a decrease to inventory and an increase to cost of goods sold, okay? All right. Good. All right, that's number 5. Let's take a look at number 6. Number 6, hopefully you can see that here. Number 6 says Walker, we're Walker here, Walker returned $200 of the merchandise purchased in 4. Okay, so remember back in number 4, it's helpful sometimes to go back and read the earlier ones if it references back. So in number 4, we were the buyer and we purchased $3,000 in merchandise. It looks like we're returning some of that now. Now, we haven't paid for this yet, right? I mean, so that $3,000, where's that sitting right now? That's still sitting in accounts payable, isn't it? In accounts payable. So we're returning some of this inventory, aren't we? So here's what we're going to do. We're going to take it out of inventory. Why? We're returning it, right? So we need to reduce inventory with a credit. So we're going to credit inventory for $200. For $200. And that's number 6. And since we're returning it, we're assuming that that whoever we bought it from is accepting the return. Didn't tell us otherwise. So we're just going to assume that they're going to take it off our bill. So we're going to also reduce accounts payable by $200. In other words, instead of paying $3,000 for this inventory, the assumption is we're only going to pay, what, $2,800 for it. Okay? Assuming we don't take any other discounts or anything like that. Okay, that's number 6. All right, so again, that entry there, you can see, is a reduction to inventory and a reduction to our accounts payable account. Okay, there's your debits and credits. Okay, let's take a look at number 7. Number 7 says we're going to apply the discount from the credit customer in number 5. Okay, so let's go back and read number 5. Number 5 was the one where we recognized revenue of $4,000 on the sale of merchandise on account. The terms of the sale were 210 and 30. Well, now they're telling us in number 7 to apply the discounts. So the assumption here is the customer's paying us, and it looks like they took advantage of that 2% discount, right? That 2% discount. So here's what's going to happen here. We're going to need to figure out what that discount amount was, right? Well, so let's think about this. So if we had, what, $4,000 in the original sale amount, we're just going to multiply that by the 2%, right? And if you work that number out, 0.02, that's $80 in discount, is it not? $80, just real simple, right? $4,000 times 2% is $80. All right, so the next question is, well, what do we do with that entry? How do we actually apply it here? Well, if you think about it, just got to really think this through. What we're saying is, since we offered that to the customer and they took advantage of it, they're really going to pay $80 less to us, right? When we actually record the actual payment coming in. So what we're going to do is we're going to reduce sales revenue with a debit by $80. And if you're kind of wondering why, well, think about it. If they're going to pay us $80 less for the amount, then it's really $80 less in sales revenue that we're getting. So why not reduce the sales revenue amount by that amount? So we're going to debit sales revenue by $80. Now again, with every debit, we need a credit. Well, we're also going to take it off of their accounts receivable balance. Remember, they haven't paid us yet, or they're paying us now, but we haven't recorded it. So we've got to go ahead and put that in. So we're going to go ahead and reduce with a credit accounts receivable $80, right? So now you can look at their balance in accounts receivable, and what is it that they owe us right now? Well, they owed us $4,000. We just reduced it by what? $80. So really, they're going to pay us what? $3,920. And if you look at step 8, what does it say? Well, step 8 says received payment from the customer in 5 net of the discount. Well, okay, we just figured that out, right? So step 8 means that we're going to record $3,920 to cash, or as an increase to cash, and $3,920 as a decrease to accounts receivable, which should basically clear their balance out. So if you're ever confused what that amount is, just go ahead and look in your accounts receivable balance. It should always tell you what that amount is. So we're saying here a debit to cash of $3,920 and a credit to accounts receivable balance for the same amount, and that should actually get us to where we need to be. Okay, great. So that takes care of 7 and 8. Let's take a look at the last 2 here. Number 9. Number 9 says, apply the discount for the merchandise purchased in 4. Don't forget to deduct the amount returned in, let's see, well, it was in 6 before calculating the discount. All right, well, let's think about this. So in number 4, Walker purchased, we're Walker again, right? We were the buyer. We purchased $3,000 of merchandise, and the terms were 315 and 45. Okay, so let's think about this. But the terms were 3% on that entry back in number 4, right? They were 3%. So if we take the discount, we can apply a 3% discount off that amount. But here's the deal. In number 6, we returned $200 of that merchandise. So would it be fair for us to take the 3% off that full amount? Probably not, right? If you think about it, what we've got to do here is we've got to take the $3,000, we've got to minus out the $200 that we returned. That leaves us with what, $2,800. Let's think this through. I'll show you in a minute. And then we're going to multiply that by 3%, aren't we? So there's your equation, isn't it? 3,000 minus the $200. That leaves us with 2,800. And then we're going to multiply that. We're going to multiply that by the 3%. That should give us what, $84. All right. So that's the amount of discount that we need to apply to this transaction. So let's think about this. Now, again, we're the buyer here, right? And whoever sold us the merchandise allowed us to take this discount. So they're basically saying, hey, we can take this off our bill. Well, it really comes off the cost of the inventory too, right? Because we're just paying $84 less in inventory. So here's what we're gonna do, 2 things. We're gonna take and we're gonna debit accounts payable by $84. Why are we debiting accounts payable? Because we're reducing it, right? We're not gonna pay that $84 because whoever we bought it from said, hey, we could take it off. So we're gonna debit $84 there. And then we're going to credit inventory by the same amount, $84. I'm going to credit inventory by the same amount. And the reason why we're doing that again is because it's really $84 less that we paid for the inventory. We always record inventory at its cost, right? So it's $84 less. Great. All right, that takes care of 9. We're almost done. All right. In number 10, it says Walker paid for the merchandise purchased in number 4, less the amount that was returned in 6, and the discount. All right, well, we pretty much already figured this out, right? Basically, if we think about this, the original amount was $3,000. We returned $200, right? And then we took off $84, did we not? Right? In the discount. We just did that a minute ago. So the amount that we have to pay out to pay this bill off is $2,716. $2,716. And here's your equation, right? 3,000 minus 200 minus 84. You could also see this really by just taking a look or a close look at your accounts payable balance. Take a look at your accounts payable balance. All right. Take a look at the second and third lines there. You have your 3,000, right? Minus your 200 minus your 84. So the balance that's sitting in accounts payable right now is 2,716. So really all we got to do here is we got to pay out 2,716. So we need to credit cash by that amount. And then debit accounts payable by 2,716. And that should zero out our accounts payable balance. So again, there's your debits and credits. So that's a debit to accounts payable, credit to cash, and that gets us where we need to be. All right, so hopefully that's a good rundown of the types of transactions you'll see here. Really, it's all about practicing and going slowly. Don't try to rush these things. If you try to rush, you're going to read something into it that's not there. If you really stop and just think these entries through, go slow and think these entries through. Use your T account. Got to use your T accounts in this chapter. It's so key because you can see those balances. That's the only way you're not going to make a mistake. So even in the online utility where you're actually putting in journal entries in many cases, your T accounts are what's going to make you sure of your entries. So even if you're working through a problem, make sure to print out that blank T account page from the last chapter and actually just work through those in T accounts, and then you can transfer them to journal entries. It's pretty easy. All right, wish you luck in this chapter. Practice, practice, practice. Like I always say, if you have questions, you know how to get a hold of me.